This is Trading Lesson 24, delivered by Atuegbe Ehizogi. This is for forex traders, crypto, stock traders, option traders, and other related chart traders. You are advised to subscribe to this channel, share, like, and make comments. You can contact us for account management, training, consultation on +234 803 75 97 085. Intraday charts have their own version of gaps. Every trend bar is a spike, a breakout, and a climax. And since every breakout is a variant of a gap, every trend bar is a type of gap. Trend reversals on all time frames always happen at support and resistance levels because technical traders and programs look for them as areas where they should stop pressing their bets and begin to take profits. And many will also begin to trade in the opposite direction. It is important to realize that the news will report the fundamentals are still bullish after the market has begun to turn down from a major top, and still bearish after it has turned up from a major bottom. Just because the news still sees the market as bullish or bearish does not mean that the institutions do. Trade the charts and not the news. Price is truth, and the market always leads the news. Most major tops do not come from climaxes made of huge bars and volume, which are more common at major bottoms. More often, a top comes from a trading range, like a double top or a head and shoulder top, followed by a breakout in the form of bear spike. However, tops can be climatic and bottoms can be trading ranges. In fact, about 80% of trend reversal attempts fail, and that is why you should wait for them to evolve into pullbacks and then enter in the direction of the trend. Also, 80% of attempts to break out of a trading range fail, and it makes far more mathematical sense to fade the tops and bottoms of the trading range than it does to buy large bull trend bars near the top and short large bear trend bars near the bottom. Since the bars are larger on a higher time frame chart, your risk is greater and you have to reduce your position size. Most traders prefer to trade off a single time frame and not switch back and forth, taking different sized positions and using different size stops and profit targets depending on the time frame. You are never going to be 100% certain of any trade, but when you are reasonably confident that the trade looks good, you have to trust the math, take the trade, and simply accept the reality that you will lose some of the time. That is just the nature of business, and you cannot make a living as a trader unless you are willing to take losses. Remember, a Major League Baseball hitter who fails 70% of the time is considered to be a superstar and makes millions off that other 30%. Once you believe that the market has reversed, it usually will pull back to test the proud trend's extreme. before the new trend unfolds. Usually, close is close enough. If two things are similar, they will behave the same. When the channel is steep, it is better not to enter a reversal trade on the breakout through the trend line and instead wait to see if there is a breakout pullback that sets up a second signal.